Last month I made over $25,000 trading this very simple approach, and this month, only 1 week into March, I'm already up over $12,000, repeating the system that I'm about to teach to you. Now this is a question I get asked quite often by my mentees and from my audience, is how to differentiate the difference between internal range structure and external range structure, and what are the things to look for and how to act or behave differently in those different market conditions, and what kind of things to look for before you actually get involved in trades. So I'm going to be drawing on the chart right now some examples. So first of all, we're going to start off with internal structure. Now this is going to be covered on the 4-hour time frame, which is the time frame that I use to build my trade idea. If you're here for the first time, welcome to my content, and I typically trade 1 to 2 indices and 2 to 3 time frames, but the most time I spend is on the 4-hour chart. So that's where my structure lies, on the 4-hour. And I'm going to be drawing on some structure. If you're new to structure, not too sure what structure even is, don't worry, I'll try and make this as simple as possible. If you've been trading for 5, 6, 7 years and you're doing the break-even dance, or you're not quite consistently profitable yet, this is also going to help you as well. So 4-hour internal structure is when we have a trending market, higher highs and higher lows, and then we see a shift to the downside where the 4-hour begins to print lower lows and lower highs, right? Now, if you haven't already watched my video from last week, I suggest you do that because it covers a trending market, right? But for now, let's assume that the higher time frame macro sentiment of this asset is a bullish market. So overall, if you zoomed out, or if you went from a 4-hour time frame to a daily time frame, just went up one time frame, we would be assuming that we are in a bullish market. Now the 4-hour has now shifted bearish, right? So what I normally do is I use a Gann box range, and I would cover the most recent range high, and we can see that if we break the low here, it doesn't really matter, but if we get 1 and 2 breaks lower, that's confirmation for me that that time frame has shifted bearish. Now this for me is internal structure, because I'm always going to be looking for buys in a bullish market, right? You can look for counter trend sells, positions to the downside, but that's more advanced stuff and you don't actually need to do that. So what do we need to be doing in this internal structure before we start getting involved in buys again? So if the 4-hour is printing lower lows and lower highs, so you have a lower low and you have a second lower low which leaves behind a lower high, it then creates another lower low which leaves behind another lower high, then what we're waiting for is the same thing that happened that created the pullback. We use a Gann box on the most recent bearish 4-hour range, and we wait for price to fail to push lower, create a new high, and then to start shifting to the upside. And then what we have is we have a clear identified target, which is the structural high to the left over here. This is our target to start buying once this has happened. And 15-minute wise, which is the time frame that I spend most of my entries on, I will use the 5-minute maybe 20% of the time. I'm probably using the 15-minute around 75% of the time, and I'll use the 1-minute about 5% of the time. But most of my entries I do prefer to take clear off the 15-minute. So once we've had higher highs and higher lows forming on the 4-hour, and we would assume this is a second higher low, we wouldn't know that until it breaks the high. But on the 15-minute, what we want is the same thing to happen. So I draw it on here. This is the 15-minute, creating lower lows and lower highs. We see a 15-minute shift to the upside, creating higher highs and higher lows, and now we can start to buy. And we will keep buying and keep buying until we at least reach this higher time frame structural high. And I'm going to share on the chart some positions that I took literally yesterday, which was the 5th of March, following this exact framework. What you could also do at this point, if you want, which is just solid trade management, instead of taking profits at the structural high point, you could trail your stop and continue that trade assuming that that bullish trend is going to continue. But you need to treat that on case-by-case basis. The reason I closed my trades out this morning here is because tomorrow for me, the 7th of March 2025, is non-farm payrolls. So I wanted to be clean out of the markets and take my profits and just relax. So that's internal structure. Remember, that's the 4 hour, right? Next up, we're going to be covering external structure. And I have some examples I'm going to show you. So let's just grab this and we can draw on the 4 hour chart again. Now remember, this is 4 hour chart. So we have 4 hour in a bullish market, which is printing higher highs and higher lows. Now, how would we behave in this sort of market? Remember, if the 15-minute time frame is what I would assume 80% or above of your entries to be, the 15-minute time frame is all you need for entry. If the 4 hour is printing higher highs and higher lows and it's not creating any lower lows, the 4 hour can, by the way, run liquidity like this. That's fine. It does not mean we have shifted bearish. This could be a 4 hour sweep of liquidity. Let's add this in there. You see, one low, two low is confirmation of a shift. One low and a reaction to the upside is just a sweep at that stage. So let's now draw on the 15-minute chart and identify what we would do. So we would wait simply, let's say after this 4 hour swept. Now, if you're going to get a 4 hour on a liquidity, that means your 15-minute is very likely bearish. It's printing lower lows and lower highs. So the same thing you would do, you would wait for when internal 4 hour range structure, you would wait for that 15-minute to shift bullish at this point. And then what do you have? You have a higher time frame target, structural high, right? And you've got then down here, we'll use a range box on the 15-minute. 15-minute is now in alignment. So if I zoom in slightly, and this is where you would start buying. So you would buy and buy until this higher time frame target is met. Now, in an external structure situation, this is when I am much more likely to hold my positions beyond the structural high point, because your trade entry is way down here. Once you're a 2-to-1 and above, or once we've broken a structural high, especially a 4 hour, that's usually when my risk is off the table and I'm looking to extend profit. So I would keep my position open, and this is 15-minute I'm drawing on here. You might get a run on liquidity on the 15-minute, not a shift bearish, and you could hold that position to the next structural point, right? Which is here. Or you could keep holding still. And I'll go over a trade example of this as well, right? And if you didn't take a position in here, you would take a position in here. If you didn't take a position in here, you'd take the position in here. Your 15-minute entry model or 5-minute entry model is simply this: a high, a low, a high, a run on liquidity, a retrace candle, and an entry inside trading session. So this I would expect to happen inside of here, 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 and here, right? This is exactly how you would be more aggressive. You can see more opportunity in an external structure market. The same entry model up here to the right. On an internal structure scenario, your entry wouldn't be until around here. And then perhaps another one around here. You would need at least a 2-to-1 to target the highs, or you would trade beyond, but you wouldn't be trading any of this. So you'd be more patient, you'd see less opportunities, you'd need to wait more, you'd need more price action to develop. This is where the mechanical rules come into play. Yes, there has to be discretion. There's absolute discretion in my trade style, and there has to be. Through experience, you realize that you have to feed some discretion into your plan. You cannot trade a 100% mechanical strategy 100% of the time, right? Because there are two different market conditions, as you can see, what I've just taught you here. So let's run over the charts, and we're not going to go through all of this because it'd be about a 3-hour video, but I'm going to pick a couple of these. But just to show you at a glance, first of all, we have some examples. We have external structure. You see it's broken this high, and it's creating higher highs and higher lows. So the 4-hour shift's bearish. So we are internal structure until it breaks this high. And then we are external structure again. We have another example here. Then you can see the 4-hour shifts lower, lower lows, lower highs. It's now internal structure until it breaks this high. We get a range bound market after that, and then all of this becomes internal structure. All of this, and much larger because it runs daily liquidity, but that's for another video. Then we get a break of these highs, and we're into external structure again. As soon as the 4 hour shifts bearish, lower lows and lower highs, we are now internal structure. This is Christmas and New Year 2024. So internal range structure until we break the high. Then what are we? External structure again. 4 hours bullish, 15-minute is bullish. We have a really nice example of a run on 4 hour liquidity inside here, where we continue just like the example that I showed here. 4 hour run on liquidity, continuation, still external range. This one inside of here, right? External structure. We're still external structure. We are still external structure because this drive in lower just runs into more 4 hour liquidity, but doesn't create lower lows. So we're still buying, still external structure, still external structure. 4 hour shifts lower, so we get a lower low and a second lower low. So this is all internal. And this is the consolidation February, March time that we have just broken out of. I'll just draw kind of broadly. You can see we've pushed to the upside. And then we are into external structure potentially next, depending on how the market reacts over the next 24 hours. Got NFP tomorrow. So let's pull up some examples. I'm going to go over a very recent example. This is only a matter of weeks ago, and then I'll pick one from months ago. We go from external range structure. Remember, this is the 4 hour chart. We go from external range structure on the 4 hour because we are printing higher highs and higher lows and nothing less, right? Until we get to this point where we shift bearish. So if you've watched one of my videos before, you know what I'm going to do next. If you haven't watched one of my videos, then welcome, and you're about to learn something very simple to use over and over again, very repeatable. Use a GAN box. These are the settings on the screen, 0 and 1 on a GAN box. And you see this drive in, which initially could be seen as a run on 4 hour liquidity here, but it creates a second low, which gives us confirmation that we are out of alignment. We are bearish in the 4 hour, whereas higher time frame macro and daily would be still bullish. So we're waiting at this point. What are we waiting for? Well, just as the drawing outlined earlier, and I'll just come back to it for reference. We're at this point, right? We've created lower lows. So we want to draw a range on every final bearish 4 hour range until it gets a break to the upside. And that's what we're waiting for. So let's zoom right in. So the final bearish range, the lower low and lower high is here, which gets broken to the upside. First of all here, and then it breaks again, and it comes back and it takes 4 hour liquidity inside of here. And this is where we can look on the 15-minute. Remember, 15-minute is bearish. We want to wait for 15-minute to turn bullish, and then we can buy. Where would the target be once we're buying? We have a structural high or beyond, right? So let's go down to the 15-minute and have a look what's inside of here. So just like I mentioned, 15-minute is bearish, printing lower lows and lower highs. It runs into the 4 hour low. We get a shift to the upside, and we get 15-minute liquidity, which is the 15-minute entry model to take to the upside, right? We have an opportunity here. Yes, it is slightly outside of kill zone. I did mention this trade in my YouTube video last week as well, which is why I'm going to show multiple opportunities from a number of months ago. And I'll show this trade on the screen now as well, so you can see that I did actually take this live on a live account. And with this, even with a 100-point stop, you're looking at 5-6 to 1 just to that structural high. You can trade beyond, but then you're risking things like this, right? Which that would have resulted in a break even when you know you can take a 5 or a 6 to 1. It's unnecessary. I actually closed out my trade around here for this. I had a slightly larger stop. I had about a 4 to 1 on this position, and profits were taken, right? Now let's go back to the 4 hour, and let's just pick a random other internal range structure. Let's go all the way back to September 2024. So it's quite a far way ago, right? Now, external structure, we're using the same practice. High highs, higher lows on the 4 hour until we see a shift to the downside. We use our Gambox to identify a shift in market structure. We get a very large drop lower, which is first of all indicative of maybe a momentous move, which is something that I use as a term for a single leg down rather than two for confirmation, just to give you the perspective that the likeliness of price being a liquidity sweep is lower if we have such a large move, especially if it's a number of candles. If it's one candle, then that's quite manipulative, and I'd class that likely as a sweep of liquidity. We've got 1, 2, 3, 4 large bearish candles after each other, but the confirmation is when we get a second low, which we get here. So we keep waiting. When we follow the lowest lows on the 4 hour, so we have a lower low and a lower high, and we wait for it to shift to the upside. And then what would we wait for on the 15 minute? We wait for the 15 minute to start creating higher highs and higher lows. Now this is a great example because there's two scenarios here. First one is that the 4 hour can come back and sweep liquidity like the previous example, right? You might print a 4 hour low, a 4 hour high, and then take 4 hour liquidity before then continuing. But I know that we don't know exactly which one's going to happen, but it's either one or the other. If we come back for 4 hour liquidity, I actually prefer that because it gives extra volatility because of the liquidity that's involved, and it also lets me buy at a lower price, which means my risk to reward is greater. It just allows me that extra confirmation as well. But if I am happy, if I've got profit to play with, if I've got confidence in the setup, and we see price action case by case, even though these price patterns, these consolidations, these pullbacks are very repeatable, they are still also unique as well. So you have to look at it case by case. There's nothing wrong with just saying, okay, we've had a break to the upside on the 4 hour. I'm just going to go straight in now and start buying on the 15 minute. Worst that's going to happen is you're going to take potentially one loss or one break even if the 4 hour comes back for liquidity. But in this case, the 4 hour doesn't generate more liquidity. It comes back on the 15 minute only. So let's go to the 15 minute and have a look inside of here. And this is a while ago, so I cannot remember at all if there was any setups. Let's have a look if I've got my kill zones correct. I've just got to change my kill zone settings because of the time zone difference. So let's move this back. My London session, by the way, is 8 a.m. till 10 a.m. UK time, and New York for me is 2:30 till 4 p.m. again UK time. So I'll adjust those. And where are we? All the way back here. Here we go. So this is our 4 hour bearish range. This is our 4 hour shift to the upside. And this is our 15 minute, which has already begun to create higher highs and higher lows, right? What it does next is it drives into these 15 minute lows. So it takes out London lows, Asia lows, session based liquidity. We get a nice retrace candle inside the New York session, and then we get a continuation to the upside. So let's have a look to see if there's an entry potential inside of here. I usually go for a 15 minute retrace candle. The only one that would really tag you in, unless you market execute on this first one, would be this one here. So you'd get in with around 130 point stop. Now, it's not the stop loss that determines whether the trade's worthwhile. It's the risk to reward. Remember, I have a minimum 2-to-1 to a structural high point for it to be worthwhile. Now, even though 131 points is quite large, I agree, normally averaging at the minute around 70 to 100 points, but it depends on volatility in the markets at that time. This is September 2024. But we can get almost a 4-to-1 to the structural high. So we can do that, right? We can do that, that's fine. What we could also do, which is more risky because you're being more aggressive, is you can refine to a 5 minute entry. Now it's more risky and more aggressive because you're assuming before the 15 minute candle is closed that the 15 minute candle might be too large. Now you could do this all the time. You could just make your 15 minute entries 5 minute entry every time. And as you can see, you'd get in earlier. You'd also have a slightly tighter stop. So you could get in with like a 100 point stop. And if we go back to the 15 minute just to see that what that does, instead of a 3.8 to 1, you'd get a 5.7 to 1. So inherently additional risk, but you're getting another 2 to 1 out of that same position. Either way, that's just a 5 minute refinement that I've given you there for free. Right, and we can continue. Let's just see if there is any continued trades in here. So we got 15 minutes creating higher highs and higher lows. still creating higher highs and higher lows. And inside of here, depending on when your ranges are, we have a liquidity sweep inside of here. We have another liquidity sweep inside of here, and we're targeting the highs, which are further up here, right? So let's have a look to see if there's any opportunities along the way. For me, I would have my 15-minute range here. Let's see this consolidation here. So would you go for a position after a run on liquidity here? Possibly. You've got another one here. So let's say you took this position. Let's say you get a -1 on this one, right? I probably wouldn't have been tagged in on this, as you can see. That candle, then we're going to wait 1 whole hour before you're tagged in. Price doesn't drive lower, however, so we'd maybe even be tagged in on this one. Looking for stop loss protection below this low. To be fair, that would have probably kept you in. This is what I always do, right? If you've watched my videos before, instead of saying, okay, below the entry candle, let's just have a certain number of points, or rounding up to a certain number of points stop loss. If you look to the left, if you've got any kind of low to the left, and the only first low we've got is this one, the second one is that one, either are fine. Even if you go for the close by one, that actually keeps you into the position, right? Does it keep it into the position long term? It looks like it does. So obviously I'm rushing in this video, but we need to be looking at what we would do in a real life scenario. Nothing wrong with it being a -1 because you still made profit on the first position anyway. You also have a New York position, so if you missed out on that one, or if you took a -1, you could do the same exact thing here. Stop loss placement below this low, about the same thing, pretty much the same entry price as well, and the same profit target. So you're looking around a 5-to-1 for each of those as well. And then we can see here, there is a definite loss inside of here. The market is not perfect. Let's have a look. It's before that range happens, actually. We do have this internal Asia sweep here, which looks really clean, to be honest. There's not really any stop loss protection underneath here, so as long as you're beneath London and Asia lows, you'd have the same target and you'd be taken out for a loss on that. Don't know if there's any news to avoid, it depends, but yeah, obviously you're not going to have 100% risk to reward on every single trade. Excellent. So there's a couple of examples there. Now let's run into external range examples. So external range is when we break 4-hour structure. Let's just choose this one here. So December 2024, and let's just go down to the 15-minute. The 4-hour is self-explanatory. It breaks a high and it impulses, and we expect that continuation to the upside. Let's go down to the 15-minute. 4-hour, we've done our work. All we're waiting for is 15-minute run on liquidity and continuations to the upside. We already get one straight away. We get a run on liquidity inside of here. Now if you take this candle or that one, because it drives slightly lower, that's fine. Around a 70 to 80 point stop is fine. That gives enough breathing space. There's no stop loss protection. There's no extra lows all the way down here. That's not necessary. Now trade management wise, because we don't have anything to the left, this is all-time high external structure territory. So you would either adopt a fixed risk to reward, 3-to-1, 4-to-1, 5-to-1, just like my last video, or you could wait for 15-minute to keep breaking structural highs, which we'll use on the purpose of this video. Every time 15-minute breaks a high and it creates a low, we trail our stop below that low. So let's keep following that. We actually have another entry here as well. You can see sweep of liquidity, an entry at New York session. Following a breaker structure to the upside here, we would move our stops on this position below this low. This second trade would now be at break even. Let's pull these over. And let's monitor these two positions with a trailing stop loss rule, because we are external range structure. We get another break, so we move our stops below here. We've now locked in 1.5% on the second position and nearly 6% on the first. We break again, move our stops again, break again, and move our stops again. This is where we get tagged out of both positions, right? So we end up with almost a 3-to-1 on the second position. and almost a 7-1. So you got a 10-1 out of 2 positions there using that trailing stop loss management, right? If you were adopting, let's say, a 4-1 on both, then you absolutely would have taken a 4-1 on this first one. And let's have a look to see if you would have taken a 4-1 on this. Yeah, you would have taken a 4-1. So you would have made an 8-1 with a fixed 4-1. You would have made a 6-1 with a fixed 3-1 on both, or a 10-1 trailing your stop. So profits all around, slightly differences. Obviously, with trailing stop, you can get more risk to reward, but you can also run taking break-evens on later positions. That's absolutely fine, that happens. Let's go back to the 4 hour and pick one more scenario. I want to pick 2 scenarios of each in terms of external structure. We've just chosen this area here, we've covered that. And let's go and pick the next one. Right, so this was 15th of January this year. This is an interesting area because I actually didn't trade at all in 2025 until around the 15th of January. So I waited 2 weeks because I didn't like this consolidation inside of here. I wanted to break out of this structural high, and I was waiting for a 4 hour body close above, the same thing that we had on the 2nd of December, which will allow me more confidence that price is going to continue to the upside following the 15 minutes. So let's just come back to this and have a look at the 15 minute again. Again, the 4 hours creating higher highs and higher lows, and that's what we expect to continue. So we don't need to do anything else on the 4 hour. It's much easier, right? So we have a 15 minute range here. We can see it breaks to the upside early London. I'm not trading that session. So let's move up to here. We see we have a clear sweep between London and New York session. I'm just going to adjust my kill zones as well now that we've changed time zone. Just 1 hour ahead. There we go. So this adjusts. Let's let that catch up. Here we go. So that now allows this sweeping candle inside session. So low volatility in the market, which means smaller stop loss sizes. We can use the previous low, which is a bit overkill, around a 55 to 60 point stop on this. Looks more than enough breathing space on the position. And let's adopt the same principles, and we'll compare again 3-1, 4-1, even a 5-1, and trailing stop on these positions as well. Let's just have a look to see if there's another opportunity. So we break to the upside. We have a sideways consolidation. There's no runs on liquidity on the 15 minute the next few days. So price impulses away. Not much in terms of opportunity inside of here. Now I do remember taking a lower time frame entry inside of here. This is the 21st of January. And this is just me recalling to memory, by the way. This is not pre-planned, but I'm fairly confident that I took, it was either a 5 minute or it could have been a 1 minute entry inside of here. Yeah, here we go. So we got the 21st of Jan, New York session, expecting a continuation. We have this low, which is just taken inside of here. Now you could drop to a 1 minute, you don't really need to. You could go off the 5 minute stop loss protection below the previous low. Again, same management style, not making it up. And this is not a structural high, this is just 15 minute. So we can trade beyond that. You could also, if you missed it, trade above the next candle or the next one or the next one. It's not gonna make much of a difference at all. Your direction, your trade timing, and your stop loss placement are way better than execution accuracy, right? I say that often. So there's a trade there. Let's go back to the 15 minute and just have a look another couple of days to see if we get any more opportunities. So 15 minute continues. Nothing in London. That's our 15 minute range. We do get internal range liquidity sweep in New York that day. We get a position nice and clean. As you can see, like I said at the start of the video, most of my entries are off the 15 minute. There's no stop loss coverage to the left. We don't want to choke the trade. 30 points is very minimum for DAX. Let's just round it up to 40 because 30 is quite low in fairness. And I just want to play this back to make sure that we can see when the market comes back. So I want to just do this, Because if we're going to trail our stops, we want to know accurately where it's taking us out. Right, so we've got 3 positions here. Well, they're all reaching 5 to 1s, 4 to 1s, and 3 to 1s. All right, so that's easy. So you've got either 9% with fixed 3 to 1s, you've got 12% gain with 4 to 1s, and you've got 15% gain with a fixed 5 to 1. You can see you can be much more profitable in external range structure in a trending market, which is why I love it so much, which is exactly what I teach my mentees in my trading accelerator program. Let's also have a look at when 15-minute structural highs break, which I have marked out with these ranges already. So the first one, so break even at this point, then below here. You may or may not have trailed underneath here and been taken out for a 4 point. Let's just say, for the argument's sake of this video, that we're taken out on this wick. So we're not saying, okay, let's hold this to the moon. Let's say we're taken out of this one with backed 4.7. That's fine. Here we get a 15-minute structural high that I've missed out here. So we are below this. We get a break above here. So on position 2, we are at break even. And here we've locked in 6.46. And then we can see 15-minute is creating new highs up here. So let's just use our stop below this low here, which is in the evening, so we are still awake. And we go to bed at night, locking in 5% on the second position, which takes us out the very next day. And this position, a massive 14 to 1. I mean, let's even make that stop loss bigger. Let's just make it a 50-point stop, which we don't need to, still a 9 to 1. So you've then got 9, 14, 18 to 1. So again, trailing that stop loss in external range structure environment is more profitable than a fixed 3, 4, or 5 to 1, but it's still profitable no matter what you do. Anyway, I hope you've enjoyed this video. I do recommend pausing, rewinding, and watching again. Take some notes, get a MacBook open, pen and paper. So a key summary of this, we've got 4-hour external range structure. You've got 4-hour internal range structure. When the 4-hour is external, you want the 15-minute to be printing higher highs in alignment. And you can continue buying until either the 15-minute shifts or the 4-hour shifts. If the 15-minute shifts, you're waiting for the 15-minute to shift again bullish. The 4-hour is still bullish, so you continue to buy. If the 4-hour shifts, you wait for a longer period of time. You could be waiting days or a matter of weeks sometimes until the 4-hour shifts bullish again. Then you're waiting for that last stage, which is the 15-minute to align with the 4-hour, and then you can continue to buy. So if you're looking at working with me one-on-one to really accelerate your trade, like I say, I've bagged over $25,000 last month. I'll show it on the screen, and it's only the 6th of March today. I'm up over $12,000 alone. I've got the best prop firm link below, 10% off if you use coupon code ScottFX, all uppercase. You get 10% off all Funder Pro challenges, and you can apply to work with me one-to-one for 12 weeks in my Traders Accelerator program, where you can get results like these students. And I'll see you on the next one.